You see $5,000 hit your account and it feels like real money. 2 weeks later, you're looking at your balance and it feels like you're living on $800. Nothing huge happened. You didn't buy a car or a TV, and yet the paycheck is basically gone. This isn't bad luck. It's the structure of your money. The core problem is simple. Your brain plans around the headline number, but your life is paid for with what is left after a long list of automatic claims on that money. Most people mentally treat "I make 5 grand a month" as if it were $5,000 of decision-making power. In reality, only a fraction of that is truly flexible, and that fraction gets smaller the more commitments you've already locked in. Take a very typical structure. Start with $5,000 net pay into your account. Before you make a single conscious choice, some version of the following is already lined up. Warm $600, $2,000 for rent or mortgage, $400, $600 for car payment and insurance, $300, $500 for health insurance premiums and medical costs, $150, $250 for utilities and phone, $400, $600 for groceries, $200, $300 for minimum debt payments and subscriptions. Add those ranges up and you are already in the $3,100, $4,200 zone. In other words, available money is closer to $800, $900, not $5,000. Most people believe they are being responsible because each commitment taken alone is defensible. The apartment is in a safer area or closer to work. The car is reliable. The insurance is necessary. The subscriptions are only $10, $20 each. None of these choices feel like overspending, but money does not care how reasonable each item is. It only cares about totals. This is why your paycheck feels smaller than it looks. By the time the money arrives, most of it has already been promised to your landlord, your lender, your insurance company, your past self who used credit, and various services that quietly renew every month. What you experience as "my paycheck" is actually a long chain of pre-committed payments plus a small leftover that you mentally inflate. The result is predictable. You feel like you should be saving more because you earn enough. But when you try to move a meaningful amount into savings or investing, it feels impossible. Any attempt to set aside $500 or $800 clashes directly with fixed obligations and day-to-day costs. So saving is done with whatever remains at the end of the month, which is often close to zero. From the outside, your income level suggests stability. From the inside, your cash flow feels fragile. That tension makes people assume they're bad with money or that they just need a higher income. In reality, the gap between $5,000 and what actually behaves like $2,800 is structural and measurable. Before talking about solutions, we need to break down exactly where that gap comes from and why trying harder doesn't fix it. To understand why a $5,000 paycheck behaves like $2,800, we need to look at three layers: how the income is structured, how people react to that structure, and what is missing in their financial system. First, the structure of the income. Most people don't get a clean, free $5,000. If $5,000 is your net, it already means taxes, Social Security, Medicare, and possibly health insurance deductions have been taken out. So the $5,000 is not gross. It is what's left after the government and some fixed benefits. From there, the money runs through another set of automatic claims. Look at a realistic monthly layout for someone with $5,000 net. Rent / mortgage, $1,700 car payment, pulls insurance, $550 health insurance premiums not taken from paycheck, plus copays, $250 utilities, phone, internet, 230 groceries and essential household items, $550 minimum payments on credit cards, loans, $250 subscriptions, apps, streaming, gym, small services, $150 total, $3,680. That leaves $1,320 unassigned on paper. But this is before fuel, irregular medical expenses, clothes, gifts, eating out, small daily purchases, and any savings or investing. Very quickly, the true flexible amount, what you actually feel, moves closer to $800, $1,000, and that assumes no unexpected costs. Second, behavior. People do not experience money as a spreadsheet. They experience it as a series of days and decisions. When they see $5,000 arrive, their brain anchors on that number. They feel more relaxed. They say yes to more small comforts, and they assume there is room for it. But the big commitments were already locked in months or years earlier. The level of rent they chose, the car contract they signed, the debts they carry, the recurring payments they allowed. Those choices were not made with a clear rule, like fixed costs must stay under 50% of my net income. They were made one by one. Because of this, day to day behavior is built on a false sense of capacity. Someone may think, I can afford a $60 dinner, I make 5K a month, without mentally subtracting the fixed 3,600 plars that is already reserved. The same thing happens with subscriptions, delivery fees, and small upgrades. None of these decisions are extreme. The problem is that they are not made in the context of a clear structure. Third, the absence of a system. Most people do not have predetermined percentages for saving, investing, or maximum fixed cost levels. They have no written rule such as 20% of my net goes to savings and investing every month, or I will not let fixed costs exceed 50 up 55% of net income. Without these boundaries, the default system is fixed costs grow until it feels tight, and savings happen if there is something left. That is not a plan, it is a reaction. Standard advice like make a budget or cut back on eating out does not resolve this problem. If fixed costs are structurally too high, cutting a few dinners or canceling one subscription will not change the feeling that your paycheck disappears. If you are saving when possible, a classic monthly budget often ends up as a document that describes the problem instead of fixing it. The deeper issue is that there is no mechanism that claims a portion of the $5,000 for your future before everything else gets it. The paycheck feels like $2,800 because taxes and commitments silently get priority. As long as the structure works this way, you can feel disciplined, track expenses, and still experience every month as a near zero result. When a $5,000 paycheck constantly feels like much less, it usually comes from a small set of repeated mistakes. These mistakes are common, socially normalized, and look harmless in the short term. Over 5, 10, and 20 years, they create a large gap between income and actual financial progress. The first mistake is letting fixed costs grow without a hard limit. Many people allow rent, car payments, insurance, and other recurring bills to reach 65, 75% of their net income. On $5,000, that means $30 to $150, $3,750 is locked in before food or flexible spending. In that situation, even trying to save $500, $700 per month feels unrealistic. Over time, this high fixed cost ratio makes any setback, job loss, medical issue, or emergency expense immediately dangerous, regardless of income level. The second mistake is saving what's left instead of a defined amount. If you wait until the end of the month to see what remains, you are letting lifestyle and impulse spending decide your savings rate. In practice, this often produces a 0.5% savings rate. Compare two simple scenarios over 10 years at a modest 5% annual return. Person A earns $5,000 per month net and saves 5%, $250 a month. After 10 years, they have about $38,000 invested. Person B earns the same $5,000 but saves 20%, $1,000 a month. After 10 years, they have about $152,000 invested. Income is identical. The difference in results comes from one decision: savings rate and automation. The third mistake is attaching every pay increase to lifestyle upgrades. When a paycheck rises from $4,000 to $5,000, many people immediately move to a more expensive apartment, upgrade their car, and increase day-to-day spending. On paper, their income grew by $1,000. In reality, their fixed commitments grew by $900, $100. After 5, 10 years of this pattern, they are earning much more but saving very little. The extra income has been fully converted into long-term obligations instead of assets. The fourth mistake is underestimating small recurring expenses. Subscriptions, delivery fees, memberships, and small conveniences can easily reach $150, $300 per month. Over a decade, $200 per month not invested is $24,000 in cash, plus roughly $7,000, $9,000 in foregone growth at 4 or 5% per year. That is the price of small items that never felt significant. The fifth mistake is assuming the income level itself guarantees progress. People think, once I make 5K a month, I'll be fine, and then do not adjust their behavior when it turns out not to be true. They do not set new rules. They do not restructure their budget. They simply continue as before with a larger number. After 10, 20 years, they may have earned a total of $600,000 while $200,000 in take-home pay, but their net worth is far below what those sums suggest. The long-term consequence of these mistakes is a life that feels permanently tight, even at an income level others would consider high. Financial stress does not come only from low pay. It comes from a weak conversion rate between pay and assets. The numbers show that the real problem is not the $5,000 itself. It is how that $5,000 is pre-committed, unplanned, and allowed to be consumed by decisions that were never placed inside a clear system. The solution is not to chase a bigger paycheck first. It is to change how the $5,000 you already receive is allocated and controlled. The goal is simple. Make sure a clear portion of that money becomes savings and investments every month, instead of letting fixed costs and small habits consume nearly all of it. The first step is to work with your real number. Take your actual net income, in this case, $5,000, and stop thinking of it as roughly 5 grand. Write it down, then list all your fixed monthly costs: rent or mortgage, car payment, insurance, utilities, minimum debt payments, subscriptions, basic phone and internet, and any other recurring obligations. Add them up. This tells you your fixed cost load. A practical target is to keep fixed costs at or below 50-55% of net income. On $5,000, that means no more than $2,500, $2,750 going to obligations that cannot easily be changed month to month. If your number is currently $3,500, you don't fix it overnight, but now you have a benchmark. Each decision going forward, renewing a lease, changing cars, adding or canceling services, should move that fixed cost number down, not up. Over 12, 24 months, these choices create real room in your paycheck. The second step is to set a fixed savings and investing rate, not a fixed dollar amount based on how you feel that month. For many people at this income level, 15, 20% of net income is a strong, realistic target. On 5,000, 15% is $750 per month, 20% is $1,000. Pick a number you can sustain, even if you start at 10% and plan to increase later. Then make this amount automatic. Set up a transfer on payday that sends the money directly into a savings or investment account before you see it as spendable cash. Mechanically, this flips the order of priority. Instead of taxes and bills coming first, then lifestyle, then savings if possible, the sequence becomes taxes already taken, savings and investing, automatic transfer, fixed bills, and only then flexible spending. You are deliberately moving yourself up in the line of who gets paid from your own paycheck. The third step is to assign every future pay increase a clear rule. A simple approach is the raise split. 50% of any raise or bonus goes directly to increasing savings and investments, and the other 50% can increase lifestyle. If your net income rises from $5,000 to $5,400, an extra $200 per month goes to investing, and $200 can support a slightly better lifestyle. This way, each improvement in income permanently strengthens your finances instead of disappearing into higher fixed costs. The fourth step is to simplify your accounts. Use 3: one for fixed bills, one for day-to-day spending, and one for savings. Investing. On payday, money is distributed automatically. Savings first, then a fixed amount into the bills account, and the remainder into the spending account. You no longer look at one big balance and guess how much is safe to use. Each account has a clear purpose. This approach is stable because it does not rely on willpower. detailed budgeting apps, or perfect tracking. It relies on a few percentages, simple thresholds, and automation. You are not trying to manage every coffee. You are reshaping the structure so that over time, less of your $5,000 behaves like $2,800 and more of it becomes visible progress in your savings and investments. We can now turn this from an explanation into a simple system you can actually run on a $5,000 paycheck. The structure has four core elements. You work with net income, not rough estimates. You set a fixed cap on your total fixed costs. You define a clear savings and investing percentage and automate it. You assign a rule to every future raise so it doesn't disappear into lifestyle. Here is how this changes your situation over time. If you earn $5,000 net and currently have fixed costs around $3,600, your first goal is to slowly move that down toward 2,500, 2,650. That will not happen in 1 month. It will happen through concrete decisions, choosing a less expensive apartment at lease renewal, not increasing your car payment when you replace a vehicle, trimming unnecessary subscriptions, refinancing, or paying down high interest debt. At the same time, you set a starting savings and investing rate, say 10% of net income, which is $500 per month. You automate that transfer to run on payday into a separate savings or investment account. You do not wait to see if the money is left over. After 1 year, you have three visible changes. You know exactly what your fixed costs are as a percentage of your net income. You have transferred about $6,000 into savings and investments. You have a repeatable pattern. Money moves by rule, not only by feeling. The monthly experience will still feel tight at times, but there is now a clear reason. You are deliberately capturing part of your paycheck for your future instead of letting everything be consumed by current expenses. Over 5 years, assuming you can raise your savings rate toward 15-20% as you adjust fixed costs and possibly get small raises, the numbers become more meaningful. For example, at $800 per month invested at a conservative 5% annual return, you are in the range of $55,000, $60,000 after 5 years. This is money that would not exist under the Save What's Left model. You are no longer only working for monthly survival. Part of your paycheck is clearly visible as assets. After 10 years, the system has a compounding effect. At $800 per month for 10 years at 5%, the invested amount moves into the 120,000 plus range. If your income has grown and you have applied the raise split rule, directing half of each raise to savings and investing, your monthly contribution may be higher and the total assets larger. The core point is that the gap between what I earned and what I kept is now much smaller. Your $5,000 paycheck no longer behaves like $2,800 used to. A consistent share of it has been converted into long-term security. The immediate steps are straightforward. Write down your exact net income. List and total your fixed monthly costs. Choose an initial savings investing percentage, even if it is 10%, and automate it. Define a simple rule for future raises, for example, 50% to savings, investing, 50% to lifestyle. Separate your money into three accounts: bills, everyday spending, and savings, investing. There is no promise of fast wealth here. What changes is the direction of your financial life. Instead of watching each $5,000 paycheck dissolve into commitments and small decisions, you put a clear structure between your income and your behavior. Over time, that structure does more for your stability and options than an extra $1,000 a month ever will on its own.